Right now, while everyone and their brother is watching NVIDIA earnings, there's a macro story unfolding in the background that could affect every stock in your portfolio, not just for a day or for a week, but for months and maybe even years to come. Oil is back over $110 a barrel. No doubt you noticed the massive increase at the gas pump, but why does that matter for investors? In this video, I'm going to explain everything in detail, how we got here, what it means for inflation, the Fed, and most importantly, what it means for you as an investor. So I will point out some of the smartest ways to position yourself in the market right now. Now, watch the end, because the actual call I'm going to make is the most important thing I've shared in quite a long time. But remember, even though I'm sharing the data and my thoughts, I'm not giving you personalized investment advice here. Always do your own due diligence before making any investments. By the way, I'm Steve Reitmeister. I've been investing for over 40 years. I spent many years as editor-in-chief at Zacks.com, and I'm a partner at WallStreetZen, where I help build our quant ratings model and handpick the best stocks through my Zen Investor newsletter. If you like timely market updates like this, then please hit that like button. It tells me to record more videos along these lines in the future. First, let's start with a little context in the situation with oil, meaning how did we get here? In late February, war broke out between Iran and the U.S.-Israeli coalition. And almost immediately, Iran did something that sent shockwaves to the global energy markets, especially because they closed the Strait of Hormuz. Here's why it matters so much. Every barrel of oil leaving Saudi Arabia, the UAE, Iraq, Kuwait, Qatar, it all moves through that one narrow waterway. 25% of the world's entire seaborne oil supply goes to the Strait of Hormuz. Then, all of a sudden, it was closed. IEA, perhaps the most credible energy body in the world, called it the largest supply disruption in the history of the global oil market. Stock markets fell immediately with a roughly 10% sell-off in March. Then on April 8th, a ceasefire was announced. Oil pulled back, stocks rallied, and a lot of people started doing victory laps. The market acted like it was all over. Sadly, here's the problem. The Strait never fully reopened. There was never actually a resolution. And now, tensions are intensifying again, and oil is back above 110 and may believe set to go much higher. That brief sigh of relief was premature, and that's exactly where the story starts. So now let's dig into the current story with oil and what the data tells us. So even with that ceasefire in place, the Strait never really came back online. Tanker traffic stayed well below pre-war levels, and there's still no agreement to fully reopen it. The supply picture isn't improving. If anything, it's only getting worse. Here's what the IEA's latest numbers show, and they are pretty striking. More than 14 million barrels per day are now effectively shut in from Gulf producers. To give you a sense of scale, the entire United States consumes about 20 million barrels a day. So we're talking about a disruption that's nearly that large, and it's happening every single day. Since March, global inventories have been drawn down by 250 million barrels. Here's what the IEA's responded by coordinating the largest emergency reserve release in their history, 400 million barrels from strategic stockpiles around the globe. And here's what's sobering about that. Fatih Birol, I hope I'm saying that right, is the head of the IEA and the most credible voice in global energy. He stood in front of the G7 finance ministers just this past week. He told them that these commercial inventories could last only a matter of weeks. Strategic reserves are not a bottomless well. So the supply shock is real. It isn't easing, and the market is starting to price that in, which is exactly why oil is sitting above 110 again. And here's where it gets really interesting for anyone with money in the stock market. But before I get to that, if you're gaining value from this video, then please hit the subscribe button and notification bell. I'm doing more and more of these timely videos, and that's the best way to ensure you don't miss any of the next ones. Okay, back to why the recent oil price surge changes the stock market landscape. Energy prices this high roll into every inflationary indicator. That includes PPI, CPI, and the Fed's preferred PCE index. Just last week, the producer price index, the PPI, came in too hot, as in way too hot. That's a producer pricing pressure. And when producers pay more, consumers usually pay more down the line. That pressure eventually shows up across broader inflation gauges like CPI and PCE. Gas prices are up more than 50% since the war started. Jet fuel prices have nearly doubled. Shipping surcharges are back, and airlines are raising fees once again. This is no longer just an oil market story. It's a real economy story. The market spent the first half of this year pricing in rate cuts from Kevin Warsh. That's the new Fed chair who came in with one job: get rates lower and keep the economy moving. That's because lower rates leads to economic growth and stock market gains. At least that was the plan, not so much anymore. But it may not be wise to keep betting bullish on stocks with energy prices this high and potentially going higher. And you cannot cut rates aggressively when inflation is reaccelerating. So Warsh is kind of stuck in between a rock and a hard place. You either cut rates and risk fanning the flames of inflation, which typically leads to a recession and bear market, or hold rates, leading to slower growth in inflation, also known as stagflation, not exactly enticing, or you raise rates, which chokes economic growth and often leads to recession and bear market. Meaning there are no good options for the Fed at this time. And that's the setup investors are trying to navigate now. And the result is shaping recent market movements, which frankly I hate. To explain why, let's take a closer look at what's happening in the market right now. Let me show you this chart. Notice how many industries are down 7 to 12% in the past week alone. When the average stock in the industry is down that much, then it's quite likely that some of the individual stocks in the group are down 15 to 20% or even more. And yet, what is happening to the overall S&P 500 index is kind of coasting near the highs. It looks totally fine on the surface. That is what we call a rolling correction. An outright correction is when the whole market falls about 10%. That's what happened in March. A rolling correction is different. With a rolling correction, the overall index stays relatively flat, kind of in a consolidation period, but each group takes turns getting beaten up. Out with this group, in with that group, then they switch places, then they switch again. Energy is up, tech sells off, semiconductors bounce, something else rolls over. This screenshot demonstrates what it looks like under the surface with some of the biggest recent losers, right? You got big losers, big winners, the overall market not seeming to do much, right? That is a rolling correction. Every day is a new story. It's swirling, it's irrational, and I hate this kind of volatility. I know you do too. Here's maybe the only thing that can keep you sane during these times. No, it's temporary. And like this famous saying goes, this too shall pass. Most consolidation periods break out in the same direction as the previous trend, which in this case would be to the upside. So hopefully this is the pause that refreshes, where the coil is being reset to spring higher. But only if it is true and lasting peace deal with Iran taking place, unlocking the Strait of Hormuz, and what that means for energy prices and inflation. So I've shared some sobering facts, but what can you as an investor actually do with all this? Here's where I land. We ran up probably about as far as we can without the Iran deal in hand. The market knows that. That's perhaps why it's consolidating and why things are so out of whack right now. Okay. But when that deal comes together, it sets off a bullish chain reaction of lower energy prices, easing inflationary concerns. The Fed likely is able to cut rates, the economy grows, and yes, stock prices press higher. Rest assured, the U.S. wants a peace deal. This is a very unpopular war and only gets more unpopular every time voters drive by a gas station. That's not a good strategy going into a midterm election as we have this year. So I'm not panicking. I'm not going to cash. What I'm doing is making sure I'm positioned for what comes next after a peace deal is in place. Before I tell you how I'm positioning, here's a tool that can assist you in any market condition. Every Monday, I share my stock of the week with investors. These top picks combine the power of the Zen Ratings Quant model with my greater than 40 years of investing experience. It's completely free. You can sign up using the link in the description or the QR code you see on your screen. Back to my investment strategy at this time. The perfect antidote to volatility in a rolling correction is to employ a buy-the-dip strategy, meaning to snatch up the best growth companies that are going on sale for no good reason. The buy-the-dip strategy inside Zen Strategies is built exactly for this, as is our buy-the-dip stock idea screen, which you can access using the QR code on screen. Now, I'm curious what you think. Do you believe a peace deal is the most likely scenario, or are you planning for more war and higher for longer energy prices? Share your thoughts in the comments section below. And if you want to see another video about a timely market topic, then don't miss our gold market predictions video. It's on screen right now. Thanks again. See you next time.